Welcome to the deep dive. If you're like most people trying to figure out this economy, you're probably feeling the pinch, right? Prices are up, markets are all over the place.
Yeah, it's volatile.
And maybe you've had that thought, like, should I just pull everything out?
Yeah.
Go to cash and just wait?
Absolutely. That's a totally normal reaction. I mean, standard advice usually says, de-risk, hold cash when things get shaky, dollars seem safe.
Today we're digging into a strategy that just, throws all that conventional wisdom right out the window. We're talking about Robert Kiyosaki, the rich dad, poor dad guy. He just put out this really stark warning, said it on social media. He sees a huge economic collapse coming, like imminent, and then a really bad recession after that.
Right. And here's the kicker, the paradox we really need to get into today. He's predicting this total disaster.
Yeah.
But he's not selling, he's buying aggressively.
Buying into a collapse.
Buying hard. So our mission today is to kind of get past the headlines, the shock value, and really understand the thinking behind it. Why is this veteran investor going completely against the grain? And what economic ideas is he leaning on?
Okay, and when you say aggressive,
Yeah.
these targets he set for 2026, they're wild. He's talking Bitcoin hitting $250,000.
Order of a million, yeah.
And gold, $27,000 an ounce.
Yeah.
Plus, he's buying silver, and now, this is interesting, he's making a big play in Ethereum too.
It's not just random numbers, though. It's all based on this core idea he has, this worldview that forces you to rethink what money even is.
Yeah, that's the foundation, isn't it? The split he talks about, real money versus fake money.
Exactly. That's the whole game for him. Everything flows from that distinction.
Okay, let's unpack this then. We got to start there. What on earth does Kiyosaki mean by fake money? Because, the dollar in my pocket feels pretty real.
Well, for him, the US dollar is the ultimate fake money. His whole argument is that the Fed, the US Treasury, they're just printing machines now.
Printing machines.
Yeah, basically printing endless amounts of cash just to pay off the country's massive and growing debts. He calls the U.S. the largest debtor nation in history. And that printing, that's the core problem.
That's quite a statement. But hang on, isn't the dollar backed by, the world's biggest economy, global trust? Is it just the printing? Or is it the speed of the printing that worries him?
It's both, really. It's the speed and the fact that it can be printed endlessly to cover debts. He sees it like an IOU that's constantly being diluted, watered down.
Okay.
So in his view, anything a government can just create out of thin air in unlimited amounts, that's fake. Real money, on the other hand, that's the hard stuff, things defined by scarcity.
Things they can't just print more of.
Exactly. Gold, silver, the classics. And now, Bitcoin and Ethereum, the digital versions of scarcity.
Right, which leads straight to that famous line of his, the saver is the loser. Kind of provocative.
It is, but it follows logically from his premise. Think of it like orange juice, right? If you keep adding water.
It gets weaker and weaker.
Precisely. The government keeps printing dollars. It dilutes the value, the purchasing power of every single dollar already out there. So if you're just saving cash in a bank, earning next to nothing in interest, inflation is eating away at your money's value.
So the cash you saved last year buys less this year. You're literally losing ground just by holding it.
You got it. He sees cash savings as a melting ice cube in this environment, a liability. So his solution, while it sounds radical maybe, is simple. Get out of fake money, your cash, your bank deposits, and convert it into real assets.
These hard assets, gold, Bitcoin.
Yeah. Get them now, he says, because he believes they'll hold their value. Or even skyrocket when the dollar system eventually, hits the wall like he predicts.
Okay, so that's the core idea. Fiat money is flawed, save in hard assets. But let's get back to those numbers. $27,000 gold, 250K Bitcoin. That's extreme. He must be banking on some really powerful forces to make bets that big.
Oh, definitely. He's leaning on some big economic ideas and other experts, too. That $27,000 gold target, for instance, he sources that from economist Jim Rickards.
Rickards, right?
Yeah, Rickards argues that's roughly the price gold would need to be to properly back the amount of money floating around, adjusted for inflation.
Wow. Okay. And the Bitcoin target.
He sees Bitcoin as basically a lifeline, the escape hatch for people trying to get away from unstable government currencies, the fake money. So these aren't just small price bumps he's predicting. It assumes a real crisis of confidence in the dollar.
What's really caught my eye, though, is Ethereum. He hasn't always been big on ETH, has he? More of a Bitcoin guy traditionally. Why the change?
That's a good point. He actually credits Tom Lee over at Fundstrat for opening his eyes to Ethereum more recently.
Tom Lee? Okay.
Yeah. See, Bitcoin's strength is its pure digital gold scarcity, right? But Kiyosaki seems to have realized Ethereum's power is different. It's about its utility. It's the foundational platform.
Platform for what exactly?
Well, especially for stablecoins. That's the big thing he mentioned.
Okay, hold on. Quick definition for everyone listening. Stablecoins.
Right. Think of them as crypto dollars. They're digital tokens pegged, usually 1-to-1, to the US dollar. They're super important in the crypto world for trading, lending, borrowing, basically doing business without constantly swapping back to traditional bank dollars.
So they're like the digital plumbing for crypto finance.
Kinda, yeah.
Yeah.
And because Ethereum is the biggest, most used, most robust blockchain for building and running these stablecoins, Kiyosaki now sees it has this huge built-in advantage. It's like the main highway system for this new digital dollar economy that's growing.
So it's not just about scarcity like Bitcoin. It's about being essential infrastructure.
Exactly. It's utility through DeFi, smart contracts, all that stuff.
Yeah.
It gives it this powerful network effect. That's why he's bullish long-term. It has exponential usefulness.
That idea of utility and network effects actually leads us perfectly into these two economic laws Kiyosaki apparently uses to back all this up. Let's start with Gresham's law. Sounds old.
It is old. Gresham's law basically says, bad money drives out good money.
Okay, what does that mean in practice?
Think about old coins. If you had two coins, both worth, say, $1 face value, but one was made of cheaper metal, maybe mixed with junk, and the other was pure silver, which one would you spend first?
I'd spend the junky one and keep the good silver one, obviously.
Exactly. You spend the bad money and hoard the good money. Kiyosaki applies this directly to today. He sees the dollar being constantly printed and losing value as the bad money.
And gold, silver, Bitcoin. Those are the good money.
Right. So as people wake up to the dollar losing its purchasing power, they won't necessarily just dump dollars. They'll rush to spend those dollars to buy and hoard the real assets, the good money. And that action pulls the good assets out of circulation, making their prices shoot up.
I get the logic. But right now, the dollar's still king, isn't it? For global trade, as a reserve currency. Doesn't that massive trust kind of override the bad money idea? At least for now, regardless of printing?
That's a totally fair point. And yes, for now, trust absolutely keeps the dollar dominant. Kiyosaki's playing a longer game here, though. He's arguing that the very foundation of that trust, the ability to print without limit, is what's slowly, or maybe not so slowly, eroding it. Gresham's law suggests that once faith really breaks, the shift away from the bad money could be fast and brutal.
So he's betting on that trust eventually cracking.
Yeah.
Okay, now the second law, Metcalfe's law. This one sounds more modern, applies more to the crypto side.
Definitely. Metcalfe's law is really key to understanding why someone could justify those huge crypto price targets. The law states that the value of a network is proportional to the square of the number of its users.
Right, the classic example is the telephone, isn't it? One phone is useless. Two phones let two people talk. But millions or billions of phones, the value explodes exponentially because of all the possible connections.
Exactly that. It's not linear growth, it's exponential. So apply that to Bitcoin and Ethereum. As more people use them, as more institutions adopt them, as more developers build on them, their value doesn't just add up, it multiplies, it squares.
Ah, okay. So that mathematical network effect is how he gets to numbers like $250,000 for Bitcoin. It's not just price going up, it's the entire network's value growing exponentially.
That's the idea. He's betting on the network utility becoming globally integrated.
Okay, so Kiyosaki's got his internal logic, these economic laws, but he's not shouting into the void, right? Are there other big players seeing similar risks or validating this kind of thinking?
Yeah, he's definitely not alone in the macro view. One key voice who echoes some of these concerns, especially about debt, is Arthur Hayes, the former CEO of BitMEX.
Hayes, right. What's his take?
Hayes focuses hard on the sheer mountain of U.S. government debt and how they're possibly going to finance it all. He predicts the Fed will basically be forced into what he calls secret quantitative easing, QE.
QE. Okay, that's when the Fed prints money to buy bonds, inject liquidity. But why secret? Why would they hide it?
Well, Hayes thinks announcing another massive official QE program would freak people out, signal real distress. So he predicts they'll use, or are already using, quieter methods. Specifically, he points to something called the Standing Repo Facility, the SRF.
SRF. Okay, need a translation again. What is the Standing Repo Facility in plain English?
Think of it like the Fed's permanent pawn shop for banks.
Pawn shop.
Kind of. It's a facility where banks can always go to get quick overnight cash from the Fed by putting up their treasury bonds as collateral. It's meant to keep the short-term plumbing of the financial system running smoothly.
Okay, so it's a normal stability tool. How does Hayes see it being used for secret QE?
Hayes argues that the Fed can use this SRF more and more frequently, maybe expand its use, to effectively inject liquidity into the system to help absorb all the treasury debt being issued without having to make big, scary QE announcements. It's a way to expand the Fed's balance sheet, get cash out there, but do it somewhat under the radar.
So they manage the bet, pump liquidity, but without the QE headlines. And Hayes thinks this ultimately pushes asset prices up.
Yes, historically, more liquidity sloshing around tends to inflate asset prices. When there's more money chasing fewer goods or assets, prices rise. Hayes believes this forced liquidity injection, secret or not, will be a major tailwind for assets, especially scarce ones like crypto.
Interesting. Okay, so that's a macro view. What about data? Any market signals backing this potential upside for the assets Kiyosaki likes?
Well, there was some interesting data pointed out recently by platforms like CryptoCrib, focusing on a specific Bitcoin indicator called the MVRV index.
MVRV, market value to realized value. What does that actually tell us?
It's a pretty neat metric, actually. It basically compares Bitcoin's current total market value. You know, the current price times all the coins to its realized value. And realized value is like the total cost basis for all coins in existence, the price they were at the last time they were moved on the blockchain.
So it tells you if the current price is way higher or lower than what people on average paid for their Bitcoin.
Exactly. If MVRV is high, it suggests current holders have big unrealized profits. Maybe the market's overheated. If it's low, it suggests the price is below the average cost basis. Maybe it's undervalued.
Okay, so what was the signal?
The signal was quite bullish, actually. The index had apparently returned to a level around 1.8. And historically, when Bitcoin's MVRV hits that specific 1.8 mark, it has often preceded a strong bounce back, like potentially a 30 to 50% price jump in the relatively short term.
Wow. So even amidst all this talk of potential dollar collapse, there are technical indicators suggesting the assets he favors might be primed for a rally based purely on past market behavior.
Precisely. It suggests that, separate from the big macro theory, the market dynamics themselves might be setting up for a move higher.
But history isn't destiny, right? That MVRV level shows potential, but doesn't negate the risk of the collapse Kiyosaki is worried about or guarantee the timing.
Absolutely not. It's just one data point. Kiyosaki seems to be blending this long-term, almost philosophical bet against fiat currency with an eye on these kinds of shorter-term market signals. It's a complex picture.
Okay, so let's try and wrap this up. What does all this mean for you listening right now? I mean, the core message isn't really about hitting these exact kind of crazy numbers, is it?
No, I don't think so. The numbers grab headlines, but the real takeaway is the philosophy underneath. Kiyosaki's making a massive bet on a fundamental shift away from assets governments can print at will towards assets defined by scarcity. He's essentially trying to build an ark made of real assets to ride out the economic storm he sees coming.
So what should people do with this information? Not necessarily copy him, but what are the actionable takeaways?
Right. Definitely don't just blindly buy what he buys. I think there are three key things. First, financial education is paramount. Really try to understand why he makes the distinction between real and fake money. Get your head around inflation, how it erodes savings, and what assets like gold or Bitcoin actually do functionally.
Makes sense. Understand the why before the what's. What's second?
Second, take an honest look at your own portfolio, your own asset allocation. How much of your wealth is sitting in what Kiyosaki calls fake money, cash, low-yield savings that might be losing value over time? And how much is in potentially protective real assets? That could be stocks, real estate, precious metals, crypto. It depends on your own goals and risk tolerance, of course.
Yeah, that personal assessment is crucial. Everyone's situation is different. And the third takeaway?
Third is about mindset. Preparation, not panic. Kiyosaki actually sees a potential crash as a huge buying opportunity. History does show that investors who are prepared, who have done their homework, often buy assets cheaply when everyone else is panicking and selling. The goal isn't to perfectly time a crash, but to understand how to protect your purchasing power through different economic cycles.
Right. So learn, assess, and prepare calmly. Kiyosaki's whole approach really forces us to confront a fundamental question, doesn't it? You've got one type of asset a government can print endlessly to pay its bills, and another type that's inherently scarce, often decentralized. Which one do you trust to hold value in the long run? And how are you positioning your own future based on that answer? That's really something to think about.
It absolutely is. Well, thanks for joining us for this deep dive. Keep digging, keep learning, and keep questioning those assumptions about your money.